Hello everyone, and welcome to the first episode of this year. I'm so excited to have the pleasure to discuss with you about a widespread issue, which is obviously recession. It's one of the topics that get a lot of attention nowadays. So before we actually start talking about that, I would like to first make it clear I'm not a financial advisor or a professional in any way. This is just my opinion, and the information contained in this video should not be used for financial and investment decisions. Now, let's begin. So, a recession is coming, that we know for sure. But when? First of all, why don't we start by explaining what is a recession? So, a recession is a significant, widespread, and prolonged downturn in economic activity. There are a few definitions out there, but the common rule of thumb is that 2 consecutive quarters of negative gross domestic product growth, which also means GDP, basically means recession. But many professionals use more complex measures to decide whether the economy is in a recession or not. Now, if we quickly look at how the United States defines a recession, so the economists at the National Bureau of Economic Research measure recessions by looking at factors such as payrolls for real income, employment, industrial production, wholesale and retail sales, among other indicators. So as you can see, this can go far beyond the simpler and although not as accurate 2 quarters of negative GDP measure. So the National Bureau of Economic Research, they've also said that, quoting, there is no fixed rule about what measures contribute information to the purpose of how they are weighting in our decisions. So basically they are saying that there are multiple factors that can contribute into their decision to declare a recession. So the central banks haven't yet declared a recession. However, we are already starting to see the early signs of a recession, given the massive layoffs happening at the big tech companies, and of course the increase in price of everyday goods. As you know, the cost of living crisis is getting worse day by day. So at some point we might see the central banks declaring a recession. But before we go into that, let's just tackle this. How do governments respond to a recession? So I will just give it a quick read here, and quoting just from Wikipedia, governments usually respond to a recession by adopting expansionary macroeconomic policies such as increasing money supply and decreasing interest rates, or increasing government spending and decreasing taxation. Basically what they mean by this is, of course, the governments will have to start printing more money, and eventually they will decrease the interest rates. As you know, at the moment, due to inflation, interest rates are up, but of course they are expected to decrease during a recession. They would try to also increase government spending and of course, as I mentioned earlier, lower taxes. Basically, that's what governments usually do during a recession. Now, looking at another article from Investopedia, we can see that central banks have been raising interest rates in the last couple of months, as you all know. However, interest rates usually fall in a recession, which is because as loan demand declines and investors seek safety, also bond prices rise and the central bank eases monetary policy. So first of all, how does a recession impact all of us? Well, we're effectively at the early stages of an economic slowdown. When you are looking for signs of this, you look towards the housing market, for example. We are already seeing the effect of high mortgage rates, which are beginning to slow down the housing markets. So a lot of people who already might have money saved up, they will decide to wait just because the interest rates are so high at the moment, so it's not worth to buy properties during this time. Retailers on the other side are trying to make cuts as they go along, so they are trying to introduce cheaper lines of products so that people can continue to spend, but at the same time they won't have to spend quite so much. So that's what retailers are trying to do to maintain the cash flow and keep people buying. So different regions are facing different economic risks at the moment, and the question is, can it get worse than this? Well, unfortunately, the answer is yes, it can. More people will probably start losing their jobs, and a lot more businesses will file for bankruptcy, so the overall economy will shrink. Again, I don't mean to scare you, I'm just trying to relate the facts so we can all be prepared, so we all know what steps we can take in this regard when obviously a recession will come. I think we will likely start to see much more in the way of evidence of weaker consumer spending coming through, so people will start spending less and less. If there will be a second sector that will drop after the house market slows, that would definitely be retail. But to be honest, guys, it's not surprising to see that we'll go through times of economic downturn, considering the last 3 years we've been facing so many challenges globally. As you all know, in the 2020 and 2021 we've seen the global effect of the pandemic and the deepest global downturn on record. And although we've seen a strong economic recovery in 2022, this year has been so turbulent as the global economy was actually hit by a third COVID wave as well. And then of course there was Russia's invasion of Ukraine, which has put a lot of pressure on European gas and energy industry, but also China's zero COVID policy. Basically their COVID policy scared a lot of investors and created a lot of uncertainty. Those would be some factors that basically caused a sharp slowdown in the global economic activity. However, as markets begin to adjust and stabilize, experts say that potential opportunities may emerge for investors in 2023. Now, looking at a quote from Tom Stevenson, who is the head of equity trading EMEA for Fidelity International, he said that I expect 2023 will be tough for households and businesses, but my central case is that it could be better for investors. So the argument is that a recession can actually be good for investors, as the assets will go down in value, so you could basically purchase a lot of, let's say, stocks, shares, investment funds at a lower price than usual. So in some ways that is actually a massive advantage, of course only for people who can afford it, people who already have some money saved up. So while everyday people like all of us will struggle, there is definitely a huge opportunity there to invest in low priced assets. So I would say, in my opinion, it's vital to save as much as you can during these times. And the idea is that if you invest at the market's lowest point during a recession, you are actually likely to do quite well over time. So if you're in a strong financial position at the time a recession hits, and you're actually willing to take the risk, because at the end of the day there is a risk that you are taking, there is definitely a lot of potential. This can be a great opportunity to leverage, as I said. And yeah, again, I would like to emphasize the fact that this is not an investment advice. This is purely just my opinion. You can take this information as you wish. That was it for today, guys. If you enjoyed this video, please like and subscribe, and I will see you next time.